Welcome back to The Explainer. Consider this our official halftime whistle. Today, I'm stepping right into my fat investor persona for our first half 2026 portfolio halftime report. We're doing a full mid-match tactical review, so let's skip the warm-ups and just dive right into the scoreboard.
17.2%. That right there is our overall portfolio lead for the first half of 2026. Hitting those double-digit mid-year numbers, man, that is exactly where you want to be in the investing world. We are sitting comfortably ahead of all the major indices right now. But, as any good manager will tell you, the top-line score really only tells a fraction of the story. To figure out how we actually got here, we've got to look at the individual players out on the pitch.
And that brings us to the mid-match analysis. You know, if you've been following my strategy for a while, you know I treat my portfolio exactly like a football team. Every single stock has a specific job to do. You've got your aggressive forwards trying to run up the score and your reliable defenders holding the line at the back. We definitely had some star strikers who absolutely carried the team to this 17% lead, but frankly, we also had some guys leaking goals in the back half. If we want to keep this momentum alive for the next 45 minutes of the year, we have to understand exactly why we're winning. No room for complacency here.
We are really looking at a tale of two entirely different portfolios right now. The split is dramatic. Our Singapore squad delivered an absolutely astonishing 25.8% return, just completely crushing its benchmark. But then you look at the US squad, and they were dragging behind with a 2.5% loss, totally trailing the SPY benchmark, which is hovering around 10%. So that massive 17.2% overall victory, yeah, that was almost entirely carried on the shoulders of the Singapore lineup. They basically dragged our US laggards right across the finish line. Let's see who is actually lifting the trophy for us.
Okay, let's talk about our top 5 goal scorers. It has been a totally scintillating display from our Singapore semiconductor companies. I'm talking about AEM Holdings, UMS Integration, and Micromechanics. The surge we saw in their stock prices over the second quarter was just phenomenal. This is that exact semiconductor invasion we've been positioning for. They absolutely set the portfolio on fire, and it just proves that making a concentrated, high-conviction bet in a specific sector can pay off massively when your timing lines up with real business quality.
But we have to talk about the absolute star player here, AEM Holdings, a 519% return. Just let that sink in for a second. Over 500%. Unless we have a complete disaster in the second half, AEM is locking in the Golden Boot Award for this portfolio, no question. But I'll be honest with you, the real satisfaction here goes way beyond just the scoreboard. It's the fact that we recognized this opportunity a few years ago, way before the broader market even caught a whiff of it. Look, I can't see the future. If I could, I would have just put every single dollar into AEM. I didn't have perfect visibility into this massive demand wave for memory chips and advanced packaging, but having the conviction to act on that early qualitative sensing and just having the patience to sit on our hands while the thesis played out, that is the best feeling in this game.
Now, you didn't actually have to be totally exposed to semiconductors to put points on the board. The crazy hype around semis has honestly kind of overshadowed some really solid performers elsewhere on the pitch. Take the midfield reliability of the Singapore banks, like OCBC. They held the defensive line perfectly with those super consistent dividends, but they also pushed forward and contributed to the scoreline. I definitely wasn't expecting another 30% return from OCBC this year, especially with the headwinds from lowered interest rates. It just goes to show you that absolute class acts always find a way to perform.
All of this really brings me to a locker room truth that I constantly have to remind myself of, especially when I'm glaring at the red ink on the US side of the portfolio. Form fluctuates, but the underlying quality remains. We are absolutely not panicking over the short-term volatility with our US holdings because we know the intrinsic value of the businesses we actually own. Let me give you a perfect example of how fast form can shift.
Just look at Arista Networks, or ANET. At the end of Q1, just a few months ago, this stock was bleeding, down 15%. If we had panicked and dumped it based on that poor form, we would have missed the whole show. Come April, market sentiment completely flipped, driving this massive, dramatic reversal. It rocketed straight up to a 31% gain. That kind of rapid, whiplash turnaround in the US markets is exactly why I'm not losing sleep over our current goalie leakers. Sentiment changes at the drop of a hat, but a genuinely great business just keeps executing, completely ignoring the short-term noise.
But speaking of goal leakers, let's keep things totally transparent. Here are the US portfolio laggards sitting at the bottom of our team sheet. We've got Viva Systems, Ulta Beauty, Shopify, Intuitive Surgical, and Tractor Supply. They're all down anywhere from 16 to 27% for the half. Ouch. It is definitely not pretty, and yeah, it's frustrating to watch them drag down our overall performance. But just like with Arista Networks, we have to step back and ask the hard question. Has the underlying business fundamentally broken down, or is the market just throwing a tantrum right now? Let's take one of our favorite growth leaders and put it under the microscope.
Let's talk about Intuitive Surgical, ISRG. The sell-off we've seen here is just a textbook case of the market violently swinging from blind, irrational optimism right into intense, irrational pessimism. Late last year, Wall Street pushed this thing sky high to nearly $600 a share, total blind optimism. But then management comes out and guides for some temporary, near-term gross margin compression because they're ramping up production for their new Da Vinci 5 platform. And what does the market do? It completely throws its toys out of the pram. It dumped the premium and pushed the stock below $400 today. It's like Wall Street just entirely blacked out 2 full years of incredible commercial progress over a temporary margin blip.
So the absolute most crucial thing you can do as an investor is separate the stock price from the actual business engine. And fundamentally, there is literally nothing wrong with Intuitive Surgical's business engine. Just look at the underlying quality from their start to the year. Thanks to the accelerating rollout of that Da Vinci 5 platform, first quarter revenue jumped 23% year over year to $2.77 billion. Non-GAAP EPS leaped an amazing 38% to $2.50. This right here is exactly why I love a contrarian strategy. I actually added 2 tranches to my position in March and May right into the teeth of this irrational pessimism. And honestly, I'm thinking about adding more. The long-term structural growth here is just incredibly solid.
Now, part of managing any portfolio is knowing when to make tactical substitutions. Back in April, I made the call to divest from Novo Nordisk and Zscaler. And even though their share prices have recovered a little bit since then, I don't regret it for a second. Why? Because of capital recycling. I immediately took those proceeds and deployed them into my high-conviction holdings in ServiceNow and Shopify, which, by the way, have notched some really solid gains of the run since we made the move. When you look at it over a multi-year horizon, I just have so much more confidence that this recycled capital is going to generate a superior risk-adjusted return sitting in those specific businesses.
So look, we have had a really fantastic first half. We're beating last year's returns in both percentage and absolute terms. But always remember, the match isn't over until the final whistle blows. Think about those insane legendary football matches, right? Brazil grabbing that crazy 95th-minute victory against Japan, or Belgium coming back from a 2-goal deficit in the final minutes. The stock market might not be that theatrical every single day, but a whole lot can happen in 6 months. I am absolutely not going to waste my energy worrying about macroeconomic shifts that I have zero control over. I'm just going to calmly monitor how my businesses navigate the field and adjust the game plan if I need to.
The whistle is practically in the referee's mouth for the second half. We know exactly who our star players are, we know where the defense needs tightening up, and we've got our tactical substitutions ready to roll. My focus is going to remain 100% on the fundamentals of these incredible companies, trusting the process, and just letting compound growth do the heavy lifting. I am totally ready for the second half kickoff. The real question is, if the market throws another wild tantrum tomorrow, are you prepared to play defense, or are you going to get caught offside? Keep your focus sharp, stay tactical, and I'll see you in the next explainer.